let's jump over here to our guide. Okay, and for those of you that aren't able to access it for whatever reason, this will be here for you, so you can come back to it. But I think you'll still find this useful. Okay, so what I want to dive into with this guide is a couple just really smart ways to use it, and also how to think about things around your financial planning. Okay, so when it comes to planning your finances, taxes are one of those things that are going to be almost involved in everything, right? I mean, that is going to be super, super common. But when you have taxes that are involved in everything and you don't understand how to plan for taxes, that can be a problem, right? So using this guide, this is now updated for 2023. So this is going to help you really understand some of the really foundational things you need to know when it comes to planning your long-term game plan, especially financially. So when it comes to, let's say, your income, okay? And if you're in retirement, it's quite different than if you are not in retirement. Because if you're working, you already have an income coming in, right? So your income fills up the bottom tax brackets. But if you're in retirement and you don't have any other income sources, so maybe, for example, you haven't taken Social Security yet, you can really take advantage of possibly a lower tax bracket, like the 0% tax bracket, also known as a standard deduction. So coming over to the side here real quick, these are our tax brackets, okay? So 10, 12, 22, 24, 32, 35, and 37. These tax brackets are most likely going to be changing after 2025 because we had the Tax Cut and Jobs Act that happened in 2025, and it happened in 2017, and these tax brackets are supposed to sunset in 2025. So our 12% is going to go to 15, and our 22 is going to go to 25, and our 24 is going to go to 28. Okay, and I forget what these ones are going to do. But most people here are somewhere in these brackets, okay? So let's say your income is somewhere in the 12% bracket right now at the end of this year, okay? So it's December, so we have time, okay? So I'm glad we're doing this now. So let's say you know your income, and for a single filer, your 12% bracket is $11,001 to $44,725. Actually, let me take a step back, okay? How does this all work? Let's take a couple steps back. How does this all work? So we have our tax brackets over here on the left side. But one thing we also have on the right side is our standard deduction, okay? So let's talk about the standard deduction first. So when you think about your income, we have what's called a progressive tax system here in the US. And the way that works is you start at 0% bracket, and then you end up going up these different brackets over here as you make more income, okay? But when you start, if you're a single filer below age 65 and you're not blind, your standard deduction is $13,850 for going into 2023. So next year, if you're a single tax filer, your standard deduction, your first $13,850 of income is taxed at 0%. It's a beautiful thing. Then for the married filing joint folks, if you're married and you file joints, that is going to essentially double. And the first $27,700 of your income is taxed at 0%. You can call it 0%, or you can call it a standard deduction, whatever works for you. Then if you're 65 or older or blind, then you're actually going to get $1,500 for each eligible spouse on top of the standard deduction, if you are in that situation. So let's say you have two spouses that are 65 or older, you're going to add $3,000 on top of the $27,700. If you're unmarried, single, had a household, then it's $1,850. Okay, so that is our standard deduction, also known as the 0% tax bracket. Okay, so the first amount of income you earn is going to be there, and this is what a lot of people I see just don't really have an understanding of. Is how that works is you're going to start with 0% taxes on that money. Okay. Then from there, you're going to jump over here to these tax brackets. Okay. So then we'll just use the married filing joint to start. So the first $27,700 for a married filing joint person is going to get taxed at 0%. Then the next dollar to $22,000, you're going to pay 10% taxes on that. So that's $2,200, right, on that amount. And then from $22,001 up to $89,450, the portion between $22,001 and $89,450, that portion only is taxed at 12%. This is something people really don't quite get all the time. And then let's go to the next one. The 22% bracket is from $89,000 to $190,750. So I've heard people say this before is, well, if I get a raise, then that's going to, that's going to push me and I'm going to have to pay too much taxes on it. And it doesn't really make any sense. Well, in reality, if let's say you're making $90,000 and you get a raise or a bonus, you're only going to pay, let's say you got $10,000 there, you're only going to pay the 22% on this $10K, right? It's not on the whole amount. So what you have to understand is you have a marginal tax bracket and you have an effective tax bracket. Okay, so these here are the marginal tax brackets. Your effective tax bracket is when you add them all up, including your standard deduction, and divide the number. So total taxes paid divided by total income. That's your marginal tax bracket. And for somebody in the 12% bracket, their marginal tax bracket is probably about 7 or 8%. So what that means is you're going to pay 7 or 8% on all income. But the next dollar you earn, if you're still in the 12% bracket, will be taxed at 12. But that is just the marginal bracket. So hopefully that's making sense. So if there's any questions on that, go ahead and put them in the chat. But I want you to understand this concept because it's very, very important to understand marginal versus effective. And with this guide, you're going to be able to see, where you're going to be at. And then this is going to help you make some decisions of where you should put the money. Okay? Because if you aren't sure where to put the money, because let's say you want to save it into a retirement account, for example, well, understanding where your tax bracket is really going to help you to make the best decision for where to put that money. So let's go down here. So contribution limits are up for this year, right? So if you are age 49 or younger and you have a 401k, 403b, 457 or TSP account, you can now put up to $22,500 into a tax deferred account. If you have a Roth option, you can do this. You can do the Roth option as well. And if you're age 50 or older, you can now your catch-up contribution is an additional $7,500. So this is $30,000 that you can put into a tax deferred account. So again, maybe you don't need all this money. Okay, so let's say you don't need all this money. How much money could you put away and how much money could you earn and pay 0% taxes? Okay, and this is not like the likely scenario, but it's a possibility. So if you didn't need this money, you could put $27,700 here. Plus, you can put, if you're 50 or older, $30,000 right here if you're married filing jointly. So that could be $57,700 that you pay zero tax on if you're smart with your planning. The reality is most people aren't probably going to be doing all that if you're making that kind of money, but this is just a way to think about it. So there's been some increased limits all across the board for retirement account contributions. So these are things that you want to be aware of as you're going into the new year. If you don't have a workplace plan like a 401k, well, your options, you still might have the traditional and Roth IRA contribution options. These are up $500 for the year. They used to be $6,000, now they're $6,500. And you can do a $1,000 catch up beyond that. Some people say, I've heard this before, that, I only have a Roth IRA option, so I can't save anymore for retirement because I don't have a 401k. Well, keep in mind that there are other ways to save for retirement. And the number one account to do that in beyond that, it would be called a taxable brokerage account. So it's just a general brokerage account. And having some money in a brokerage account can be very advantageous, by the way, when you go into retirement, because having another option for a tax bucket to pull from if you need income that doesn't increase your income potentially could be a really good thing to do. So for example, if all you have is a 401k and you've been deferring all the money through your whole career, and you have let's say $500,000 in a 401k, and now you want to take $50,000 out to live off of, well, that's going to be $50,000 of taxable income. If you have a taxable brokerage account you've been saving in on the side of your 401k, you might only have to pay capital gains on the gain above what you put into the account. So let's take that same $50,000 and let's say you put in $25,000 and that account grew to $50,000. If you were to take out that same $50,000, you'd only have to pay capital gains tax on the $25,000, not on the whole amount. So what does that mean to you? Well, if your income is low enough, you might actually pay 0% tax on that capital gain. So for single filers, if your income is under $44,625, and for joint filers, if your income is under $89,250, and that's taxable income, by the way. So that's after your standard deduction. Taxable income is below those numbers. You can pay 0% on that withdrawal from your taxable brokerage account. And anything above that, then you're over here in the 15% rate. But really, that's not too bad. That's really not too bad. You have to pay 15% on any income above $44,626 if you're a single filer, or $89,251. This is where our important numbers, our key numbers guide is going to come in, because this is going to help you understand what provisional income is. Okay, very, very important to understand provisional income if you're somewhere close to retirement. So let's look at this here. So provisional income, down a little bit further down here, right under where the full retirement age years are for Social Security. Okay, so provisional income. So the first thing I want to say is, if your only income, the only income you have is Social Security, then you don't have any taxes. You don't have to worry about it. There's no taxation there. But once you get to a place where you are having other incomes besides Social Security, and that may be pensions, that could be withdrawals from your IRA accounts, now you have to start thinking about provisional income. If your provisional income is less than $25,000 and you're a single filer, you won't have to pay any tax on your Social Security. If you go over $25,000, then you have to pay tax on 50% of your Social Security. It doesn't mean you're going to get taxed. Like if your Social Security is $2,000, doesn't mean you're going to pay $1,000 on taxes. It just means that if your Social Security is $2,000, $1,000 becomes taxable income. So if you're in a 12% tax bracket, you might pay 12%, on that $1,000. Not a huge deal. If you're married filing joint, well, now we have up to $32,000 that we can have in income. Then you can pay no tax on your Social Security. And then from there, you have a little kind of gap here, somewhere between $32,000 and $44,000 for 50% taxable, and $24,000 to $34,000 depending on your filing status. So married filing joint is to 32 to 44, and the single is 25 to 34. And then above $44,000 of provisional income for married filing joint, and let's say 44,000 for joint, and single is 34,000, then 85% of your Social Security becomes taxable. So this is where it becomes very important to understand how to properly withdraw from your retirement accounts. And this is something that, again, I'm very biased. Okay, I'm very biased. I'm a retirement planner. So when I look at a client's retirement income plan, there are so many opportunities on how to save money on taxes if you understand how to withdraw from different accounts at different times. And some of those accounts could just be cash savings, right? If you have some cash savings set aside and we can avoid draw from an IRA, and now that keeps us in a certain level that may be below provisional income, or maybe it keeps us in the 12% bracket versus the 22% bracket, that's money directly in your pocket. So these are real valuable insights if you understand how to plan for taxes. Sean asked the question, will capital gains rates also sunset in 2026? No. I think there's too many wealthy people that don't want that to happen. That is something that's always on the table, but that's one of those things that too many wealthy people that have money that lobby pay into that. So here's something to understand. If you're a retiree, our Aunt Irma, okay, we're going to call her, all right? What IRMAA stands for is Income Related Monthly Adjustment Amounts, okay? So when you get on Medicare at 65, you're going to have premiums, and you're going to have your Part B premium, which for 2023 went down a little bit, which is good. It's going to be $164.90. Plus you're going to have Part D, and Part D is around $69 plus. And then you can have other supplements that could cost a little bit more. So if your income is below certain levels, then you won't have to pay anything to Aunt Irma. But if it goes above, then you can start to have to pay a penalty. And the challenge with this is it's a 2-year look back. So there are exclusions or exceptions if you had to change the status of some sort. So let's say you retired recently, you can file a form and get this waived if you made high income and then you're retiring, but you will have to file that form most likely. But let's say you had a big windfall, where you sold a house, for example, or you cashed out a bunch of your IRA money and now your income was higher. So in this case, we have to be aware of income limits. So if your income and you're a single filer and your income's above $97,000, well, now you're gonna have to pay an IRMAA surcharge, also known as a penalty or also known as a tax. And this is a monthly surcharge, okay? So above your $164.90, if you go above that, you're gonna have to pay $65.90 for Part B, and then you have to add $12.20 for Part D. And that's for the whole year. So it ends up being, around $800, $900 per year. And that's for 2 years if you go over. So I had a really wonderful case this year with one of my clients where we were looking at her withdrawals towards the end of the year. And normally we just draw from the traditional IRA because that's the best account for her to withdraw from. But if we continued that through the end of the year, well, then we were going to go over and she was going to end up in IRMAA. So what we did in that case was switch her withdrawal to her Roth IRA just for a couple months to make sure she stayed under that. Very helpful. If you're married, this is a lot higher. Obviously, it's double, but this is less likely that you're going to hit this. But for the single filers, it does come up quite a bit more often. So let's say you're a single filer with a good pension and you're making above $150,000 all in with your pension and maybe Social Security and also any sort of IRA withdrawals. Look at what your surcharge could be monthly, okay? So this is where you want to look at strategies for tax planning. This can come in really helpful if you're going to have a big number that's going to come out of your accounts, especially later in life, like after 72, when you take RMDs, required minimum distributions. A lot of people are living on moderate incomes. They don't really need a lot of money, but they were great savers their whole lives. And so what happens at 72 is they end up in a place where the required distribution from their 401k or IRA can push them into higher tax brackets and even into the penalty realm for IRMAA. So this is something I really recommend if you're early on, you want to get with someone who specializes in retirement to help you map out what it looks like your future is going to look like. Because if you can get the answers and really take control of this early, you can have a much better experience throughout the rest of your retirement. So going back to our guide here, these are all things that are on here that it's going to help you understand some of these things that you need to know about, okay? And so I would start, if you're learning how to use this today for the first time, just start, looking at it and just looking at the numbers, okay? And I think the first good place to start is understanding tax brackets. Because if you can understand tax brackets, this is a really good foundation to having a good, kind of income plan for the long term, especially if you're young. Like, let's say you're young and you're making, $85,000, you're right here, and you get a bonus of $20,000. And so if you don't do anything, well, that bonus is going to all get taxed at 22% because now you're going to be in the 22% bracket. If you started putting a bunch of money in your 401k, you're going to keep 10%, more of that money. So if you get a $20,000 bonus and you put it all in your 401k, that's $2,000, right? So these are all things that can be very, very useful, very helpful to understand if you understand how to use this guide. So again, I can go on and on with this for hours, but I want you to have this as a tool. We'll start with that. And if you enjoy this, well, maybe we'll spend some more time on it. So I'd love to hear your feedback. If this is useful information, if you're finding this useful and you want to go deeper into this guide, I'm happy to do that. But it's free. Get it off my website. If you're having trouble downloading it, I'm not sure what's going on, reply to any of the emails that you get and I'll send it to you. No problem. Other than that, I want to address that question really quickly about the taxable brokerage. We have, there's really 3 types of accounts that you can invest in, okay? You can do pre-tax, which is a traditional 401k, 403b, traditional IRA, which means you put money in today. That comes directly off your income. You save taxes today in this year. We have Roth accounts, which would be after tax, also known as tax-free accounts, where you pay the taxes today, but then you put that money in that Roth account, so Roth IRA, Roth 401k, and then that money grows forever tax-free. You never pay taxes ever again. And then the third type of account is just it's not a pre-tax account, it's not a Roth account, it's called a taxable brokerage. That means it's not taxable, it is not tax advantage. And so if you put money in there and your investments grow and you sell them, then you will initiate what's called a capital gains tax, and that'll be taxed at 15% on the gain only. So there are benefits to those accounts, but ideally you want to put most of your money in either Roth accounts or pre-tax accounts first, And then if you fill those up, then you can go to a taxable brokerage. Or if you just want to have a little bit of money outside of retirement that you can get to, but you're still investing it, then a taxable brokerage can be great as well. So provisional income doesn't include Social Security. What are the Social Security tax? It does include Social Security, Dwayne. It's going to be 50% of your Social Security. So if you Google provisional income formula, it should come up. Or if you're in the Facebook group, or if you search even my Facebook page, I think I posted it there. Social Security taxation. I did a whole workshop on that. It'll break it all down. For those of you that are still on, this is a little bit of a marathon, okay? We went long, had a lot to share with you, but I really appreciate you. We're going to be doing this more often, so please turn on your notifications. If you can follow some of my social media, I'd appreciate it. I can put that back up. But other than that, I just want to thank you so much for joining today. It really means a lot to me that you did that. And I hope to deliver a lot of value to you. I want to bring this community up to speed and really help you get focused on your finances. There's a lot of talk about a lot of negativity in the world. Recessions, digital currencies, central bank digital currencies, all kinds of crazy stuff. So that's stuff we can talk about. And I'm happy to talk about it with you if you're interested. But I can't get to you if you're not following me on some sort of platform. So obviously you are here. And on our email list is even great because I'll send out some things to you there as well, like the guide that we went over today. All that stuff goes out through email. So if you're interested in that, then I know someone said you're unable to download the form. Just email the email address here, info@keepitsimplefinancial.com. I'll get it back to you. I'll be happy to take care of that, no problem. Folks, thank you again so much. I really look forward to getting back in community here with you. And if you need anything at all, feel free to reach out or shoot me an email, okay? Have a wonderful evening. We'll talk to you next time. Bye now.